Welcome to Balance of Economy, market research for education, not financial advice. Let's get into the rings. So right now, Wall Street is actually on track to hold more Bitcoin than, the anonymous creator of Bitcoin himself.
Yeah, which is a wild metric to think about.
It really is. The whole anti-bank revolution is, well, it's actively being bought by the world's biggest banks. And we have a massive stack of sources today. We're looking at data from TradingView, some brand new SEC filings, insights from JPMorgan Asset Management, and some really deep institutional reporting from Markets Media and Crowdfund Insider.
Right.
And the mission of today's deep dive is to unpack the absolute rewiring of global finance. Basically, the institutionalization of digital assets.
Or, if you prefer the unvarnished version, we're unpacking Wall Street's aggressive annexation of crypto.
And right there, that's exactly why we need some ground rules for this debate, because this topic completely splits the room. So we are taking firm stances today. I'm taking the role of the institutional optimist.
Naturally.
Hey, I'm looking at the data from our sources, and I'm arguing that heavyweights like BlackRock are finally bringing some much-needed legitimacy to this space. They are the adults entering the room. They're bringing unparalleled efficiency, regulatory clarity, and just a massive ocean of capital.
Okay, well, I am taking the role of the decentralization purist, and I'm looking at these exact same sources through a highly skeptical lens. My argument is that what we're witnessing here isn't an upgrade.
What is it, then?
It is old finance wrapping itself in a new, technological skin, which I think fundamentally threatens the original permissionless ethos of cryptocurrency.
Challenge accepted. Let's start right at the biggest front door of this entire movement, which is the $30 billion ETF milestone.
Yeah, we have to start there.
Because you really cannot debate Wall Street's presence in crypto without looking at the raw mechanics of the Bitcoin spot ETFs. And the numbers we are seeing from TradingView are, frankly, staggering.
They are moving fast.
Fast is an understatement. BlackRock's spot Bitcoin ETF, the ticker is IBIT2, just crossed $30 billion in holdings. And it did that in just 293 days.
Which is undeniably fast, yes, but I think we need to explain the mechanics of what that speed actually represents in traditional finance.
Well, it represents a definitive victory. Look at the data from Eric Balchunas. He's the senior ETF analyst at Bloomberg that's cited in our sources.
Right, the ETF timeline data.
Exactly. The previous record holder for reaching that $30 billion mark was JPI, which is a massive equity premium income fund. It took JPI 1,272 days to hit that milestone.
Yeah.
Gold took 1,790 days. BlackRock's Bitcoin ETF did it in 293. This isn't just like a successful product launch. This legitimizes the asset class on a global scale.
I hear the enthusiasm, but let's look under the hood at the structural reality of that capital flow.
The mainstream capital is officially here, though. You can't deny that.
Yes, the ETF inflows are breaking all-time records. The sources show that U.S.-based spot Bitcoin ETFs accounted for about 75% of new investment in Bitcoin just a month after they launched. But you have to look at the extreme centralization that comes with this mechanism.
I really don't see the problem there. They are providing a regulated vehicle for people who want exposure to the price, but, they don't want the technical headache of managing private cryptographic keys.
The problem is the sheer gravity of their holdings. The data shows that U.S. ETFs are on track to hold over 1 million Bitcoin collectively. The total valuation is north of $71 billion.
Which is great for the market.
But mathematically, Wall Street ETFs are about to surpass the holdings of Satoshi Nakamoto's original wallet, which holds roughly 1.1 million Bitcoin. So from a purist perspective, this is not a victory parade.
Because they hold too much.
Because a decentralized peer-to-peer asset, one that was designed specifically to remove banks from the equation, is literally being swallowed whole by the most centralized financial behemoths on the planet.
Okay, but look at the resulting price action. The reports show Bitcoin nearing $80,000.
Price isn't everything, though.
But you cannot deny that this institutional plumbing is driving massive value for every single person holding the asset, whether they are on Wall Street or, holding it on a USB drive in their living room.
Actually, we need to examine exactly why the price is pushing $80,000, because it's not just a simple story of everyday investors buying ETFs.
Right, the Bitfinex report.
Exactly. The Bitfinex analysts in our sources point out some crucial structural context about the underlying market mechanics here.
And before we unpack this specific point, I want to make it absolutely clear to you listening, we are strictly reporting market analyst perspectives from the source material right now.
Yes, absolutely.
We are not taking sides, and we are not endorsing any political viewpoints. We're just looking at the data and the market mechanics.
Precisely. So, the Bitfinex analysts attribute a significant portion of this recent Bitcoin rally not to fundamental macroeconomic adoption, but to two specific intertwined factors.
The options market and the election.
Right. The underlying structure of the options market and the prospect of a Republican presidential victory in the U.S. They are explicitly calling this a Trump hedge.
So explain the options market mechanic there, because that's a pretty complex dynamic. How does an election bet in the options market drive the actual spot price of Bitcoin up to 80,000?
It comes down to something called delta hedging. In the options market, traders are buying massive amounts of call options.
Which are basically leveraged bets that the price will go up.
Exactly. They're betting the price of Bitcoin will go up after the election. But the market makers who sell those options to the traders, they don't want to take on that massive risk. If the price skyrockets, the market maker loses a fortune.
Right.
So to neutralize their risk, the market makers are forced to go out and buy the actual underlying Bitcoin in the spot market.
Okay, so the spot price gets pushed up mechanically.
Exactly. The price is being squeezed upward by the mechanical plumbing of options dealers balancing their books in anticipation of a political event. The argument from the analysts is that this rally lacks the fundamental macroeconomic drivers, like a shift in global monetary policy or inflation, that you would normally expect to see. It's a highly leveraged, event-driven trade.
Okay, I understand the mechanics, and you can absolutely call the current volatility a political hedge. But I am pushing back hard on the idea that this invalidates the institutional adoption thesis.
How so?
Well, BlackRock didn't buy $30 billion worth of an asset in 293 days just to play a 4-year U.S. election cycle. They are building a permanent asset class.
And they're building products they can charge fees on.
But even if the ETF price action has speculative elements right now, that doesn't explain what Wall Street is doing on-chain. Because buying a Bitcoin ETF is just holding a digital rock. But tokenizing treasury funds, that is Wall Street actively building their own digital real estate.
And that infrastructure build-out is where the mechanics get incredibly complex.
Yeah.
And honestly, where the threat to decentralization really magnifies.
See, I argue it's where the technology finally reaches its potential. Let's talk about BUIDL, BlackRock's tokenized treasury fund.
Right, the BUIDL fund.
According to Crowdfund Insider and Markets Media, this fund grew to nearly $2.5 billion in assets under management in roughly a year. And the JPMorgan Asset Management Insights outline exactly why this is a massive operational upgrade.
The operational side is definitely fascinating.
We are talking about 247 settlement, instantaneous transfers, and programmability through smart contracts.
Right, but we need to break down programmability so you can really visualize what JPMorgan is excited about here. Like, what does it actually mean to program a U.S. Treasury bill?
Think of it like giving a dollar bill its own built-in lawyer and accountant. In traditional finance, if you want to move government debt, you rely on an army of back-office clearinghouses that only work Monday through Friday, 9 to 5.
And it takes days to settle.
Exactly. With BUIDL, the rules of the asset are baked directly into the code. BlackRock takes a traditional safe-yield instrument short-term U.S. government debt and puts it on a blockchain.
Right.
So if a corporate treasury wants to sweep their idle cash into a yield-bearing asset at 11 p.m. on a Saturday, the smart contract executes it instantly. And it's not staying in a private walled garden either.
Well, it's expanding across chains.
Yeah, the sources show BUIDL is expanding across multiple public chains like Solana and BNB Chain. They're integrating directly with decentralized finance lending platforms like Uniswap and Euler.
And that integration is the glaring fundamental contradiction of this whole enterprise.
How is that a contradiction? I genuinely don't understand the purist anger here. They are utilizing the technology for exactly what it was built for. Fast, borderless, mathematically verifiable efficiency.
But at what cost?
This is the promise of crypto being realized.
The contradiction is the illusion of control. You have a $13 trillion traditional asset manager operating inside decentralized, permissionless lending pools.
Yeah.
Yes, the technological rails they are riding on, like Ethereum and Solana, are decentralized.
Right.
But the actual control of the asset, that is entirely institutional.
Well, because it has to be legally compliant.
But look at the mechanics of how they enforce that compliance. BlackRock uses a company called Securitize as their transfer agent. Securitize maintains off-chain identity verification.
Which is standard KYC procedure.
Right, so you have a public decentralized ledger recording the transactions, but you have a centralized bouncer at the door controlling the official shareholder registry. Is a hybrid model.
Okay.
But if Securitize decides you violate compliance, they can freeze your tokens right there on the public blockchain.
But it brings billions in much-needed liquidity to DeFi protocols. You can't ignore that benefit.
You have to zoom out, though, and look at BlackRock's scale. They manage $13 trillion. A $2.5 billion fund like BUIDL is a literal rounding error for them.
Sure, it's a small piece of their pie.
They aren't doing this to bring liquidity to Uniswap. This is a highly calculated proof of concept. They are testing the plumbing with a small amount of capital to see how the pipes handle the pressure, before they route the real ocean of institutional money through them.
And frankly, the plumbing needs an upgrade. When institutional money flows efficiently, the cost of capital drops for everyone. That's just economics.
But when Wall Street upgrades the plumbing, they design the pipes to route the water straight into their own reservoirs.
Okay, that's a little cynical.
It's just structurally what's happening, which perfectly sets up the most critical structural shift in our entire source stack today. Because BODL was just practice. The ultimate target here is the stablecoin market.
Which is where the strategy becomes brilliantly clear, in my opinion. The target is the massive pool of idle capital currently sitting in stablecoins. We are talking about roughly $240 billion in stablecoin capital that is currently earning absolutely no yield for the people holding it.
Right, and we have to explain the mechanics of why that capital's idle, because it is the key to understanding BlackRock's entire move here.
It's definitely a regulatory issue.
Exactly. It's not because crypto users don't want to earn interest. It is strictly because of the regulatory environment. Our sources heavily reference the U.S. Genius Act.
Right, the Genius Act. It's essentially the first major federal framework attempting to actually regulate stablecoins.
And the most crucial mechanical component of the Genius Act is that it explicitly restricts stablecoin issuers from paying interest directly to the retail holders of the coin.
Which is a huge detail.
Think about how a stablecoin works right now. If you hold a digital dollar, like USDC, the company that issued it took your actual physical dollar, invested it in U.S. treasuries, and they keep the yield from those treasuries for themselves to fund their operations.
Yep.
The Genius Act essentially mandates this structure by demanding highly regulated, incredibly safe reserve assets backing every digital dollar, but strictly forbidding the pass-through of yield to the end user.
Which creates a massive structural inefficiency in the market. You have billions of dollars that need to be held in perfectly compliant, ultra-safe government debt, and enter BlackRock.
Exactly.
They just dropped 2 brand new SEC filings for tokenized funds, BSTBL and BRSRV. They are basically custom building the exact compliant yield vehicles that the Genius Act requires.
And this is the exact moment we need to pause and look at the irony here. This is the ultimate aha moment for you listening. Crypto was originally engineered to completely circumvent traditional banks.
Right.
But because of government regulation through the Genius Act, crypto companies are now legally forced to hand their massive cash reserves right back to Wall Street to manage.
But BlackRock is giving them the most efficient tools to do it. Let's break down these 2 specific funnels they built, because the structural design really is fascinating. First, you have BSTBL. This is the traditional finance or TradFi on-ramp.
Right. Look at the mechanics of BSTBL. It is essentially a digital share class of a 35-year-old AAA-rated government money market fund.
Super safe.
Very safe. But the transfer agent isn't a crypto company. It's BNY Mellon, one of the oldest banks in America. The fund only exists on the Ethereum blockchain, but you can only buy into it using traditional fiat wire transfers.
Which is so interesting. You don't even need crypto infrastructure to buy it.
No, you don't. It is structurally designed specifically for traditional bank treasury desks to dip their toes into tokenization safely.
And then on the flip side of that, you have the crypto native funnel, which is BRSRV. This is a brand new vehicle. And the transfer agent here isn't BNY Mellon, it's Securitize.
Right, the crypto native option.
It is designed to be multi-chain right at launch, and it allows for direct on-ramps using USDC stablecoins instead of fiat wires. And the most telling detail in the SEC filing, it has a $3 million minimum buy-in.
That's a high bar.
Very high. Because it explicitly targets, quote, crypto banks or financial intermediaries whose customers may be payment stablecoin issuers.
Okay, so let's map this out. BlackRock now operates 3 distinct tokenized products.
Yeah.
They have BIDL, designed for DeFi collateral.
Right.
They have BSTBL, designed for traditional bank reserves. And they have BRSRV, designed for crypto stablecoin reserves.
It's a tool for every job.
They have deliberately fragmented their own products across different compliance surfaces. My question to you, as the optimist, is why?
Well, to perfectly serve different client needs with custom-built financial engineering.
No, it is to ensure they capture every single drop of the mandatory stablecoin reserve flow, regardless of which regulatory bucket it falls into.
I mean,
As one of our sources, an analyst named Quang Trung, pointed out, this is the starting gun for the age of institutional capital flows operated entirely on-chain. But they aren't just participating in the decentralized ecosystem. They're co-architecting a new, highly centralized global reserve standard.
and I will happily defend that reserve standard because the efficiency gains are undeniable. The JPMorgan piece makes a brilliant point about cash segmentation and liquidity management.
I'm listening.
Imagine you are a corporate treasurer at a major multinational company. Right now, your capital is trapped in banking hours. With these smart contracts, you can automate your treasury management.
Sure.
You can set a rule that automatically sweeps millions of dollars of idle cash into BlackRock's tokenized yield fund the second the markets close on Friday, earning interest all weekend.
Okay, yes, the weekend yield is a big deal.
Huge deal. Then, the smart contract instantly pulls it back into a stablecoin at 6 a.m. on Monday morning to meet global payroll. No clearinghouses, no waiting for a bank branch to open. That 247 flexibility fundamentally changes the velocity of money.
Technologically, it is absolutely revolutionary. But economically, it is the exact same centralized entities dictating the rules of gravity.
I don't think it's the exact same.
Mark Bowman, one of the commentators in the market's media piece, nailed the underlying reality here. He said, this is the real institutional stablecoin play. BlackRock already manages the Circle Reserve Fund, which backs USDC.
Right.
They are already deeply embedded in the digital dollar infrastructure. They are no longer just an asset manager experimenting with tokenization. They are systematically positioning themselves to be the primary institution that monetizes the reserve infrastructure of the digital dollar itself.
But here is the critical difference from the old system. They are doing it transparently. Yes. For decades, the biggest criticism of traditional finance has been the opacity of shadow banking. Nobody knew what the banks were actually holding. Now, BlackRock is putting their money market funds on a public cryptographic ledger. Anyone in the world can verify the asset positions in real time.
But transparency does not equal decentralization.
Yeah.
Yes, you can see the ledger. You can watch the transactions in real time. But if Securitize or BNY Mellon decides to freeze your on-chain shares because of an off-chain identity verification issue,
Which they have the legal right to do.
the fact that you can clearly see your frozen assets permanently locked on a public blockchain doesn't help you. The visibility is decentralized.
Yeah.
The control layer is still fundamentally traditional finance.
But let's bring this down to earth for a second. If I'm listening to this right now and I'm not a corporate treasurer with $3 million to drop into BRSRV, why should I care about BlackRock's plumbing upgrades? How does this impact the average person?
You have to care, because this infrastructure is the bedrock of the financial system you will be forced to interact with for the next several decades.
Right.
Think about the mechanics we just laid out. If the Genius Act mandates that stablecoin reserves must be held in specific, highly regulated ways, and BlackRock successfully built a monopoly on those on-chain reserve vehicles,
And what?
then every single time you transact in a digital dollar, you are moving through their pipes.
Which means whether you are using a digital wallet to buy coffee, interacting with a DeFi lending protocol, or sending a cross-border payment to family overseas, it all eventually settles back to a Wall Street-managed, tokenized U.S. Treasury fund.
Exactly. The anti-establishment revolution simply outsourced its back office to the establishment.
Wow.
And that brings me to the final structural question I want you to really chew on today. If BlackRock's massive push for tokenized ETFs and on-chain money market funds actually succeeds in creating a perfectly frictionless 247 global market, have we actually revolutionized finance? Or have we just utilized brilliant cryptography to build a faster, more transparent cage for the exact same legacy banking system?
Is BlackRock the savior of crypto or its final boss? In a market this split, you are either a momentum chaser or a value protector. I'm tracking both in real time. If you want to see which side of history wins, subscribe to Balance of Economy. I'll see you in the next briefing. Stay sharp and stay informed.